My guest today is Dmitriy Fomichenko. Dmitry is the founder and president of Sense Financial, a boutique financial planning consultancy that specializes in self-directed retirement accounts. He is an expert on using self-directed retirement accounts to complement your investing and retirement planning strategy. He is a member of the Forbes Finance Council, where he writes frequently about self-directed accounts, and he is also a real estate investor himself and a licensed California real estate broker. Dmitry, thanks so much for joining us today to share insights and tips about self-directed retirement accounts.
Andrew, you're very welcome. It's great to be on the show.
Hey, I'd love to, first start by just learning a little bit more about your background for our listeners anyway. I mean, we connected, I guess, a couple of years back now when you were one of the guest contributors to a blog post that I had written about real estate investors' advice for new college graduates, which, by the way, I'll link in the show notes for folks who are interested. But just tell us a little bit more about how did you get into becoming an expert on self-directed retirement accounts like 401ks, IRAs, et cetera?
Sure. Well, I got to go back into my background. Actually, by education, I'm an electromechanical engineer that I went to college. As you can hear, or your listeners can hear from my accent, I'm not from here. Originally, I immigrated in this beautiful country back in 1996 from Russia, and translated my degree, which was equivalent to BS in electromechanical engineering. And I did work in the field for several years. And then I actually got laid off and was forced to look for something else. And I got started in financial services, was recruited by a local firm, and been doing that for a few years, just dealing with traditional retirement accounts, IRAs, Roth IRAs, mutual funds, college education savings, and so forth. And actually, in 1999, I was introduced to the concept of investing in real estate, been attending local real estate investment clubs, and purchased my first property in 2001. And so when I got started in financial services, I started investing as well in the market while I was investing in real estate. So I could actually see the parallel and I could compare, and I figured out that investing in real estate, I have much more control and I have much more potential for the gain. Just to give you an example, I purchased two properties. My first two properties, one in 2001 and then second in 2002. Both of these properties, in a period of about 4 or 5 years, they more than doubled in value. Now, have to make a disclaimer, the market was crazy at that time. It was a good time, but nonetheless, you do have that potential. And I pretty much used those properties or equity in those properties to kind of catapult my investment career. But in 2004, I believe, actually, I'm sorry, yeah, in 2004, I started working with a local real estate investment firm. I was invited as an advisor and been there for several years, and then market crashed in 2007, and people were looking to invest using the retirement funds. And because of my expertise and background in financial planning, I was asked to basically lead a department with this. And I started that, and about a year later, I transitioned on my own and started Sense Financial Services. So that's kind of the answer.
Gotcha. What caused you to specialize in self-directed accounts?
Well, as I mentioned, I worked with a local real estate investment company here in Southern California, and we actually attempted working with several self-directed companies, and none of them really worked out long term because they couldn't perform to our satisfaction. So I've been given a task to start a department, and I did that in 2009, actually. So I did that for about a year, and then a year later in 2010, I started Sense Financial, transitioned on my own, and that's pretty much all we do. We specialize in creating self-directed retirement accounts that give our clients checkbook control.
Cool. Well, definitely want to dive into that in more detail here in a moment. It sounds like you purchased real estate properties yourself using self-directed accounts. How many doors do you currently own? How many did you acquire using self-directed accounts, I guess, up until now?
Sure. Well, I actually acquired one property that I purchased. It was a good deal. I ended up buying that in a retirement account. And then I own another property that I kind of own involuntarily. It was a loan. I did a private loan, which was defaulted, and I received the property as a deed in lieu of foreclosure. So I currently own two properties in my retirement account, and the rest of my retirement assets are invested in private loans. So I own a number of notes in my retirement account. And for me, I actually my investment strategy just overall, whether it's retirement accounts or not, evolved over time. At one point, I owned over 20 properties personally, 20 rentals. And when I started this business, I basically um, transitioned. I transitioned, I sold portion of my portfolio, and I started doing private lending. And the reason for that is private lending is passive because rentals, they do require management. They still take time from you. And I wanted to dedicate my time completely to my business. And then also, the risk is significantly lower with being a private lender, investing in a note. So you actually act as a bank. You collect the payments, pretty much guaranteed, contractually guaranteed by the note. And returns are pretty nice as well. I average in over 10%. So you get double-digit returns. So majority of my portfolio in my retirement account is private notes, but I do own a couple of rentals as well.
Gotcha. Well, super interesting. Well, let's dive in a little bit more detail now into self-directed accounts. First, to I guess level set, help us understand what is a self-directed retirement account.
Sure. So it's very important for your listeners to understand, because some people think, well, they have an account with Schwab, an IRA, and it's a self-directed IRA. Well, it's not a truly self-directed IRA, because if you have an IRA with Schwab, you can only pick from the investments that Schwab allows you to do. And all of those investments, they're tied to the stock market. They are confined to the stock market. A truly self-directed IRA allows you to invest into virtually anything, including real estate, which is very popular. Majority of my clients invest in real estate. So a self-directed IRA, or a truly self-directed retirement account, is an account with a custodian that does not place limitations on the investments that you can make. So you can virtually invest in anything, any alternative investments, not just the stock market. So that's what the self-directed IRA is. You have freedom to choose investments.
Got it. So there are a bunch of qualified retirement plans that I think folks are familiar with: IRAs, 401ks, even solo 401ks. To help us understand, can you have self-directed for all these, and what is the difference? Why would you go with one or the other?
Well, you can have a 401k with your employer. So if you work for a company and they offer a 401k or any other employer-sponsored plan, such as 407 or 457, 403b, so you can have those employer-sponsored plan, and you can have a self-directed IRA on the side, because IRA is individual retirement account. You can have that in addition. And if you are self-employed or you work for yourself, then you can have a solo 401k, and solo 401k can also be self-directed.
So how does the self-directed version differ from their more traditional siblings that folks are more familiar with? Like, what are things that you can do with a self-directed version of an IRA or a solo 401k that you cannot do with a traditional version of those accounts?
Well, the main distinction is the investments that are available. So if you have an IRA with a custodian, like well-known custodian, Schwab, TD Ameritrade, Fidelity, you can only pick from the investments that are available by that custodian, because custodian basically they're in business to sell investments and mutual funds, maybe some stocks. So you always limited to the investments that custodian offers. And custodian, when they set up an account, they have the power to basically dictate or limit your investment options. So it's always limited to investments tied to the stock market. That's how they make money. A truly self-directed IRA does not have those limitations. So a custodian that offers truly self-directed IRA, they charge fees for you to make the investments, but they don't offer investments. So you can invest in things like real estate. You can own a physical real estate inside of your retirement account. You can also own commercial real estate. You can own promissory note, like I said, with my retirement account. That's what I do. You can be a private lender. So you can be the bank, essentially. You can invest in real estate outside of the US. I have clients who've done it as well. So you name it, there is no limit. You can pretty much invest into anything you want.
Can you have a self-directed account and an employer-sponsored plan, and do contribution limits apply across these accounts in aggregate or individually?
Well, it depends on the type of account. So if you have a 401k at your employer, for example, you can contribute to that 401k. And if you have an IRA, which is a self-directed IRA on the side, you can contribute independently. So 401k and an IRA, those are two separate retirement accounts. You can contribute. Each one of them have separate contribution limit. If
I guess, is there anything preventing me from having an employer 401k with my company and a self-directed solo 401k? Maybe I have a side hustle, etc. And then, like, does the annual contribution limit apply to both those accounts individually or together?
Well, when it comes to the solo 401k, it's a little bit different because first of all, solo 401k is a qualified retirement plan designed for those people who are either self-employed or own a small business. So if you are in that situation, you can open this plan, and it has some tremendous benefits. One of which is a large contribution limit. So with the solo 401k, you can contribute up to $63,500 for this year. In an IRA, that limit is $7,000. So as you can see, nearly 10 times. So it's a great tax shelter. If you work for yourself and if you're making a good income, then you're dealing with the problem for you, which is taxes. And the solution to that is set up a solo 401k and shelter. But the contribution limit, if you have an employer sponsored 401k and a solo 401k, the employee portion that you contribute, which is 19.5, that is subject to limit for all of the plans. So you cannot put no more than 19.5 in a given year, or for this year, that's the limit, across all of the plans that you participate. But on top of that, solo 401k has a profit sharing, which allows you to actually bump up your contributions up to $63,500.
Gotcha. There's nothing that prevents me from having both, right? Like maybe I have a business on the side and I work at a company.
Correct. You can have both. You can have employer sponsor plan, and if you eligible, meaning you work for yourself or you have a side gig, then you can set up a solo 401k as well. You can have both.
Who is a self-directed retirement account, in your mind, best suited for? Yeah, like what are the types of people for whom self-directed is a good option versus maybe the types of people who is not so good of an option?
Well, first and foremost is for those people who don't want to be limited when it comes to the investments. Because again, as we talked in the very beginning, the conventional retirement account, you have custodian who limits your investment options. And I'm sure your listeners seen what happened with the market in the beginning of the year when the pandemic hit. I don't have much invested in the market, but I was looking at my portfolio and it dropped 30%. Now, back in 2007, when the previous market crash was, I've seen some people lost 50% of their portfolio. Now think about if you're approaching retirement and you lose half of your portfolio, that can be devastating. So more and more people are uncomfortable with this idea of having investing in something that they cannot truly control. I mean, you and I and your listeners, we cannot control the stock market. Now, we can do certain things to minimize the risk, but ultimately, we don't have the control over the stock market. So, but there are other investments such as real estate, again, that you have much greater control over. In my case, being a private lender, I have a bunch of notes out there, which I own in my retirement account and personally. And my portfolio, my note portfolio has not been affected at all. Maybe I had one payment that was late. It didn't default or anything like that. So almost no effect. Whereas real, traditional market, the stock market dropped 30%. So that's the whole point behind the self-directed, is that you can invest into something that you understand more and that you can control, most importantly, and minimize the risk.
Are there important risks that folks should be aware of when it comes to investing with a self-directed account?
Well, there is always a risk when you make the investment, but actually, even if you don't make an investment, if you put your money into a CD, you're still running a risk. And the risk that is your money is losing a purchasing power to inflation. So there's risk no matter what. But obviously, you do need to understand the risk that is related to the particular investment that you're making. So in my case, I did mention earlier, I think I own one property in my retirement account, which I actually was a lender. So, and the risk when you do private lending, the risk is that the borrower may default. So they may stop making payments. So in my case, I can, maybe make this into a case study and just go over the numbers for you. But I lent $38,000 on a property in Pennsylvania. I was in the first position. And I held that note for about 3 years, and then they defaulted. It was actually a loan to a company. They owned the portfolio. So they mismanaged that, and they eventually defaulted. And eventually, after the negotiation, they agreed to do a deed in lieu. So they signed the deed over to me. And now I own a property that is worth about $65,000. My interest payment that I was receiving on that note, it was a 9% note, was $350 a month. Well, my rental income is $675 now. So as you can see, the worst case scenario actually ended up pretty good for me. So those are the risks. But if you don't do your due diligence and you land on a piece of crap, then you can lose money. So obviously you have to do your due diligence and look at the particular investment that you're making.
Sure. Okay. That's good, good advice. So what is the process for actually setting up a self-directed account? Like, can I just walk into Vanguard, Fidelity, Schwab, and open one of these up?
Well, unfortunately, these traditional financial institutions, they don't offer a truly self-directed retirement account. So you do need a specialized custodian. If you're talking about an IRA, there are two options, as we did mention earlier. There is a self-directed IRA, and there is a truly self-directed solo 401k, which I can explain process for both. But for an IRA, you do need a specialized custodian that specifically offers self-directed accounts without placing limitations on the investments. So you open the account just like you would with any other custodian. You move the funds from your existing IRA, and then you're ready to start making investments. Now, with the self-directed solo 401k, the process will be a little bit different. You actually don't need a custodian for that. Custodian is not required for a solo 401k. And instead, the plan is set up with the trust being the vehicle to hold the plan assets. So for that, you do need, again, specialized company that offers the documents for that. Company like ours, that's what we do. We are a document provider for a solo 401k. and we set up these types of accounts for our clients. But you do need a specialized company that can help you set up a truly self-directed retirement account.
I see. So sounds like I can't go into any normal brokerage. You need a specialized company. Two questions. What does this custodian do other than provide the documentation? Is there like, do they provide any other value add services? Well, yeah, let me just first start there.
Okay, so the role of a custodian is they have custody of the funds. So custodian, typically they have thousands or more customers, and they hold assets for those clients' IRAs. So if you have an IRA with ABC custodian, then they hold the assets. Now you control it, so you tell them you would like to invest in this particular asset, or let's say you wanted to buy this particular property. You obviously have to do your own due diligence, find the property, and then submit an offer. Now this offer has to be signed by the custodian. So the custodian, because they technically, so both of you will sign the offer, and then when you're ready to make that purchase, you have to submit the paperwork to the custodian and direct them to transfer the funds, because they actually in possession of your funds. So they have custody. They transfer the funds to escrow or wire the funds to escrow. You buy the property, and then when you have to make certain payments or expenses, again, you have to go through the custodian for each transaction and direct them to send the funds.
I see. So interesting. So yeah, this was one of the things I wanted to ask about. So it sounds like when I have an investment opportunity or I need to make a related, transaction or purchase, in terms of the mechanics of actually accessing the money from the self-directed account, I think what you call checkbook control, right? I can't actually self-withdraw the money myself. I need the custodian to sign off. They're going to send it through escrow. The money never passes through the account holder's hands. Is that correct?
That's correct. Yes. So as an account holder, you don't touch the money. So you always have to go through a middleman, which is a custodian. So that's for an IRA. For an IRA, you have to have a custodian. The checkbook control that you mentioned, that is available with the solo 401k, because solo 401k does not require a custodian. And with the solo 401k, the funds are in the trust, in the 401k trust, and you, the client, actually is the trustee of that trust. So as a trustee, you control it. So you physically have a checkbook control. So you will have a checking account attached to your 401k. The funds are there, and you can literally write the check. You don't have to go through a middleman, wait for the approval, lose the time, pay the fees. So you literally have checkbook control over your retirement funds with the truly self-directed solo 401k.
So that sounds better. Why do people not? Why don't people just always do that?
Well, number one, not everyone is aware of this. And number two, solo 401k is not for everyone. As we mentioned, it's designed for those people who are self-employed or own a small business. You basically have to meet the two criteria. Number one, you have to have a legitimate business or self-employment activity in place that generates earned income. Not that it cannot be a passive income. So some people, let's say, to give you an example, they may say, well, I'm in a business, a real estate business. So what it is that you do? Well, I own a number of properties, portfolio of say 5 or 10 properties. Well, from the IRS standpoint, that's not really a business. This is an investment portfolio, because the rental income is considered passive income. And so that's not considered a business. You have to have earned income. You have to do something to generate. And that can be, again, the range is pretty wide. Can be anything. You can do some consulting. You can do, I have many clients who are real estate agents who, as a real estate agent, you're actually self-employed. You can provide some services, you name it. As long as you receive some 1099 miscellaneous income that you report on a Schedule C, or if you own a actually entity, S Corp, C Corp, LLC, that you file a separate tax return for, you're eligible. And then criteria number 2, you cannot have any full-time employees working for you, because if you have employees working more than 1,000 hours for your business, then the law requires you to offer the same retirement benefits to your employees, and solo 401k cannot accommodate that.
Got it. So how do I tell what's the difference between passive versus earned income for, for those who aren't aware, in terms of like real estate makes sense. That seems like passive income, but let's say, I don't know, I'm a YouTube influencer or a blogger, and I make money on either through either way, using passive affiliate links. Like I create content, but I don't actively maybe sell anything, or maybe I do, but it's all passive in the background. That seems like it's still that would, I'm assuming, can still be considered earned income. So how do folks tell the difference between the two?
Well, again, you have to look at the source of income, where the money is coming from. And again, let me use the example of affiliate, creating those links or writing those blogs. So if you, and compare that with being like a rental property owner. So here's an example. If you have to, let's say, take a couple of months off and go, away out of the country for 2 months, when the first of the month comes, you still get that rental check coming in. The next month, you still get that rental check coming in. So you don't have to do anything to earn it. It's coming to you passively. Now with the, writing blogs or creating those affiliates, you always have to maintain that. You have to create those links. You have to create those relationships. Yeah, once you kind of set that up, it might be somewhat passive, but you have to do something to earn that. So, and again, the source of income, you have to look at the source of the income. If it is 1099 miscellaneous, because those probably affiliates will send you 10 or report that income on a 1099. So if that's going to go on a Schedule C, that's earned income. So that's, and your CPA can help you clarify that as well. Okay,
cool. So we talked a little bit about custodians, which are required for IRAs, but not solo 401ks on the self-directed side. How do people find a custodian? Like, do they just do Google searches? And how do they, more importantly, how do they compare custodians to, find the one that's right for them? What are the things that they should be evaluating?
Well, there are, obviously you can do Google search and you can search for self-directed custodians. There is actually, you may find them at some list. Some people put together lists, you may find that. But how do you compare? You have to do your own due diligence. You have to do your own research. And first and foremost, look at the client's feedback. Look at the testimonials from their existing and past clients. Look at the, go online and search Better Business Bureau, or look at their profile. Go on Google. Google has a bunch of reviews just on Google. So you can find a company on Google Maps and just look at their reviews there. Look at, see if you can connect with other clients who are actually using their services. And there are sites, the site that specifically geared to real estate investor, which I'm actually actively participating almost on a daily basis, called Bigger Pockets. So this is a site that is kind of social networking site for real estate investors. Has a lot of resources, so you can connect with other investors, you can ask questions, and you can research things like that. But ultimately, you have to do your due diligence.
Well, let me ask this way: if you were, going to search for a custodian, what are the things that you would be looking for to determine whether they're good or not? Like, what are what are the markers of a good custodian?
Well, I'm going to be a little bit biased because uh, we specialize in creating retirement accounts with checkbook control. So, and I hear from clients that they have sometimes trouble working with the custodian. They need to make an investment and they have to wait a few days, and they lost the deal because they dealt with the custodian. So, looking at the speed, how quickly they can process the transaction, but looking at also at their fees, because each custodian has a separate fee structure, and some charge based on the transactions, some charge based on the number of assets that you hold, some charge based on the total account balance, which to me doesn't make any sense.
Yeah, because how would you
Custodian,
value an illiquid asset for
well,
determining?
you still can value. There is a value to an asset. I mean, if it's a property, for example, there is a value, property values. But what doesn't make sense to me in this, if they charge based on the assets, total assets, they're not your partner. They're providing a certain service. So why should they get the percentage? That doesn't make any sense to me. But the bottom line is that I don't want to have somebody control my retirement account. I want to be in control. That's why I will go for the checkbook. That's why we offer a checkbook control. But custodian, they do work. I mean, there's millions of people who are using custodians, and it does work for them for various reasons. Maybe they not aware of the checkbook control, or maybe they do passive investments where there is very little interaction with the custodian. Because again, if you're doing passive investment, again, example will be a note. Once you make a loan, once you invest in a note, you obviously have to do your due diligence up front, but then after that, it's completely passive. You're pretty much not involved, especially if you have a servicing company, which I do use. So some people call it a mailbox money, because they just receive a check in the mailbox every month. In my case, I don't even use a mailbox, so to speak. My servicer, the broker that I use, they simply deposit the funds directly into my bank account. So it's completely passive, and that can work with the self-directed IRA as well.
Do the costs of opening and maintaining an account differ for self-directed accounts compared to regular qualified retirement accounts?
Yeah, because with just the traditional retirement accounts, if you go with Schwab or Merrill Lynch, they usually offer you a free IRA, or maybe charge you $20 or something like that. But how they make money is by selling investments. So when you invest with Dmitriy or Schwab, they make money, a little bit of money every time that you make the investment. So they make money off of your investments. With the self-directed IRA, custodian does not sell the investments. They basically provide a service. So they process transactions, and they charge fees per transaction. Again, different custodians have different fee schedules. Some charge per each transaction. Some might give you few free transactions a year. Some charge based on the assets. So every asset you'll pay them a fee, and some charge based on the total account balance.
Got it. Yeah, it makes sense. Okay. Can you roll money into and out of a self-directed account the same way you can between, other retirement accounts like 401ks and IRAs?
Yes, you definitely can. The self-directed IRA can accept rollovers from other IRAs or 401ks. So is a solo 401k. A solo 401k can accommodate rollovers from any other qualified retirement plan, with one exception, and that is a Roth IRA. IRS does not allow Roth IRA to go into a 401k, but all other accounts can be moved. One other comment I need to make is that if you have you have an employer-sponsored retirement plan. So if you work for a company and you have a 401k there, most likely you're not going to be able to transfer that 401k while you're employed. Now, if you leave the company, if it's a past employer, you can move that. Or if you reach a retirement age, you can also move that account, but not while you're employed and before retirement age.
Let's say you have a self-directed account and you wanted to roll out, say, to an employer plan, for example, and you have investments. Would you be required to liquidate your potentially illiquid assets into cash in order to roll that money out of the self-directed account back into a traditional 401k, say?
Well, you're not going to be able to do that. If you have assets in your IRA, you're not going to be able to move that into employer-sponsored plan because your employer-sponsored plan does not allow those kind of investments.
So
So
you'd have to
yes,
sell
if
it.
you,
So
if you have to, I mean, I don't know, why would you do that? It doesn't actually make any sense. I mean, I understand you may want to not, you may decide, okay, you don't want to deal with the alternative investments. You just want to get back into mutual funds. So you set up an IRA, but usually it doesn't ever make sense to move money into employer 401k. Like if you start a new job and you get a 401k there, it's never a good idea to bring any money in there. You may want to still have an IRA, just a normal IRA, because you have a lot more options with an IRA than your employer sponsored plan. Options are very limited there. So I can't think of instance why it will make sense to do so.
Gotcha. Okay. So, with like a 401k, for example, you're allowed to take out a loan from your 401k under special circumstances. And there are like just other things that you can do. Is it accurate to say that with a self-directed account, do you get all those same, does it basically work the exact same way as its qualified, sibling, traditional sibling? Like, could I take out a loan out of my self-directed 401k and things like that?
Well, you can take a loan from the self-directed 401k, assuming that the plan documents have the loan provision. So typically, the plans that we set up, yes, there is a plan provision in the plan allowing you to take a participant loan, so you can take up to $50,000 or 50% of the balance, just like with your employer 401k. But with an IRA, it's different. You cannot take a loan from an IRA. That's not possible.
So it sounds like, in any way, on the 401k side, the rules for borrowing, payback tend to be the same. Is that right?
Pretty much, yes.
Okay. So let's talk a little bit about, how you can invest with a self-directed 401k or IRA. So a lot of people use their self-directed accounts to buy physical real estate. That's one of the most popular investment asset classes that people use a self-directed account for. How is rental income treated if you invest in real estate using a self-directed account? Is that just like a dividend? It just goes right back in?
Yeah, all of the income, whether it's, if you own a rental property, that's going to be a rental income. If you own like a paper asset, for example, if you own a note, you don't own the property, but you actually a lender on the property. So you still have income, that's interest income coming in. Or if you invest into some kind of a fund that maybe owns a number of properties or owns one large multifamily property. So there is income coming in. All the income is must go back to the retirement account, because the retirement account owns the asset. Just like, the concept you mentioned in your question, the concept is the same. So it's treated just like, dividends or you receive from your mutual funds or stocks. So everything must go back into a retirement account.
What about operating costs, capital expenditures that, let's say, again, you're investing in real estate? Do those have to be funded entirely from self-directed account monies? Are you not allowed to use any outside, personal money, for example? Like, let's say there's a big rehab project you have to do at the beginning, but you don't have enough money in your self-directed account. Are you not allowed to mix that money? And if so, what happens if you mix? Like, are there tax consequences, et cetera?
Yeah, you absolutely cannot mix. So if your IRA owns a property and you're doing a rehab on that property, well, first of all, you personally cannot participate in any work. You cannot do any work on the property because you're a disqualified person to your IRA or 401k. So everything has to be done by unrelated third party. You can oversee it, you can kind of manage the project, but you cannot personally be physically involved in any of the work that is done on the property. But all of the work, all of the expenses must be paid from an IRA or a 401k. You cannot use personal funds because it's not your property. Your IRA owns this. And so that's why you need to plan accordingly. So if you're starting or considering certain investment, you have to estimate what the rehab cost is going to be. You want to make sure you have enough funds in your IRA. Now, you can also borrow money. Your IRA or 401k can take a loan and to buy the property and potentially take a loan to the rehab the property. But
You're
it
saying
has
from
to
a
be,
bank, take a loan from a bank?
you know, if you can find a bank, there's going to be limitations there. The to buy the property, yeah, there are a number of lenders that specialize that. The loan must be non-recourse. And non-recourse means that there is no personal guarantee, because as a disqualified person to your IRA or 401k, you're prohibited from providing a personal guarantee for that loan. So you can go to just any bank and get a loan, a conventional loan, because conventional loan will require personal guarantee, and that's a no-no with a retirement account. So it must be non-recourse loan. We actually have a list of non-recourse lenders who specialize in this. There is a handful of lenders who do that.
Can you send me a link to that? I'll link to that in the show notes.
Sure. Um, um, and now, if you need money for the rehab, those lenders probably not going to lend you the money for the rehab, but you can still find a loan. You probably have to go a private lending route. So maybe talk to your friends or extended relatives, cannot be immediate family members like your parents or grandparents, your kids, but you can still possibly finance it. The bottom line is you need to think about all of that before taking on the project. You need to cover all these bases.
I see. So super interesting. So do you typically find that real estate investors who are using self-directed accounts are buying it with you know, they're taking on leverage, like they're buying it with debt, or do they tend to buy it in all cash?
Oh, I see both. You can do both. You can invest using leverage, and you can invest just using cash. So
Because obviously one
obviously,
of the big benefits of using leverage is that you can increase the returns, and it sounds like you can't really go to any old bank. You have to either go to a non-recourse lender, which there's probably that's going to drastically reduce your options, or you have to go private lending. Are those pretty much the options that you have if you're a self-directed retirement account real estate investor? That it's either non-recourse, limited number of banks, or private lending if you want leverage?
well, yeah, there is a limited number of lenders who provide that, but that doesn't stop you from getting the loan. You know, you can still get a loan. Those lenders will lend. You know, maybe not all of them in all 50 states, but you will find a lender who will lend the money to you if property qualifies. So it's not a problem to get a non-recourse loan. Again, if it's a decent property, I've done it personally. I own a property in Phoenix. I purchased that about 7 years ago, maybe. And I used, I had to come up with 40% down. So it was a 60% LTV loan, but it was pretty straightforward process. Again, you can get a loan. It's not a problem. The terms going to be a little bit different, but
Can you
again,
say more about how the terms will be different?
One criteria is that you're going to have to come up with the larger down payment. Like I said, in my case, it was 40% down. If you're going to go to like a conventional lender, if you personally buying a property, you probably can get a investment property loan with 20% down. So here you need 30 to 40% down. And the reason is because the lender is taking more risk. With a conventional loan, if you default on the property and lender have to foreclose, they have an option of coming after you personally if you still owe any money. But with the non-recourse, the only recourse the lender has is the property itself. So they want to minimize the risk. That's why down payments typically larger. But again, you can still make the numbers work, and it's 40% is better than 100%.
Sure.
Right? You know, I'm still using 60% leverage, which is I'm increasing my returns.
What about like the rate, the amortization, the term? Do those tend to be similar as you know, a regular bank finance mortgage? Like, can you get a 30-year fixed, or you know, at say less than 4%, or are those going to be different too?
Different lenders have different criterias. The rates is going to be slightly higher than conventional, but again, you don't want to really compare that to the conventional because you're comparing apples and oranges. You know, if you really want to compare apples to apples, then you want to compare this non-recourse banks with like hard money lenders. You can get a hard money loan that is non-recourse, but you're going to end up paying, you know, 10, 12% interest on that in maybe a couple of points. Like to give you an example, on my property, yes, I had to put 40% down, and my rate was 4.875 on that. It was actually a 5-year fixed, so it has been adjusting, but my rate is still under 5% right now, which is still, you know, great comparing to the private or hard money lending.
Well, what's the amortization in term that folks can typically expect with these type of loans?
They do have different options. You can go 30 years, you can go 20 years, you can go 15, and maybe even 10. But you do have different options.
Got it. So it sounds like you cannot be personally involved because you're a disqualified person, as you said. Who takes title to the property? Is it your custodian or trustee? There's actually their name is on the title of the property?
In a case of a self-directed IRA, custodian takes the title to the property. Yeah, so it's going to be something like this: ABC Trust Company, FBO, which stands for benefit of, Andrew Chen IRA, and then maybe the IRA account number, something like that. Now, if you use a solo 401k, then the title will be in the name of the 401k trust. Like I explained earlier, with the 401k, there is no custodian. All the plan assets are held in the trust. So it's going to be something like ABC Company 401k trust, for example. As a trustee, you control that, but the title is taken in the name of the 401k trust.
Gotcha. Okay. Just curious, you know, it sounds like what I'm really taking away is you have to, you know, be very careful about planning to make sure that all the costs you need for rehabbing or whatever are able to come from the self-directed account and that you don't have to mix money. But in the worst case scenario, what if I misestimate, you know, lightning strikes, a tree falls on the house, and now I have a big expense. It's, you know, a black swan event. I didn't expect that to happen, and I don't have the money, and I just have to bring in outside money. Otherwise the investment is going to, could potentially go to zero, or things can go very badly. I have a mortgage payment coming up, and, you know, the asset is damaged, and I have to just fix it to get it back into rentable state. And I just have to use outside money. What happens? What are the consequences?
Well, typically, if you got something like that, you must have the insurance. Again, something that you have to do ahead of time and buy the insurance, because you have to think about things like that. So usually insurance will cover most of it. You might have to come up with a deductible. But if you, again, in the unlikely scenario where you're just out of money in your IRA and you need additional influx, you have to look at a few different options. Number one, you can make a contribution to an IRA. There's going to be limited, I think up to $7,000 for this year, but you can put some additional money. If you have any money in a retirement account, any other retirement accounts, you can do a rollover from those retirement accounts. If those options are not on the table, or you exhausted those options and still need more funds, you could potentially take, again, a private loan. Not you personally, but IRA taking a loan. So you can, put property as a collateral in an IRA to get the loan. Or you potentially can sell off portion of the property and bring in a partner. But you're not allowed to use the personal funds because that will violate the IRS rules. Because IRA is a separate entity from you, and you're a disqualified person in your IRA.
Makes sense. Let me ask this another way. If stupidity takes over and you accidentally use personal money, I'm just wanting to understand, what is the consequence on the other side of this?
So if you, whether you mix personal money in an IRA, or if you do something else that is prohibited, you basically commit a prohibited transaction. Well, in that case, entire IRA will be deemed distributed. Okay. Mm-hmm. So the IRS will treat that you actually took all the money out of your IRA, and you're going to have to pay taxes and penalties on that. And again, if you commit a prohibited transaction, sometimes penalties can be up to 100% of an IRA. So it could be pretty serious. So not to take lightly. You do need to understand what the prohibited transactions are. They're not difficult to understand. Typically, prohibited transaction arises when there is a disqualified person involved. And by the IRS definition, disqualified person is someone, basically yourself, your spouse, and your immediate family members, kids, grandkids, and their spouses, your parents and grandparents. So you want to make sure that all the transactions that your IRA or 401k involved are arm's length, meaning that none of these people are involved in the picture, in the transaction in any capacity.
Got it. Okay, good safety tip. Folks, don't do that. So let's say you invest in real estate with your self-directed account. Are you allowed to live in the property? Like, a lot of people, for example, do house hacking. They'll buy a multifamily property. They'll live in one unit, rent out the others. Are you allowed to live in the property?
Absolutely not. Again, living in a property, what I just covered, arm's length transaction, you're a disqualified person. You cannot be involved in the transaction. Living in the property, meaning you're even if you're paying rent, I mean, if you're doing it kind of illegally, I mean, without an agreement, because it's not your property, it's your IRA's property or 401k's property. So that will violate, even if you're paying a market rent for that rental, that is still not allowed, because you're receiving a personal benefit, and that's not allowed. You're a disqualified person, so absolutely cannot receive benefit from the investment.
I see. And again, the consequence would be, it would be a deemed distribution?
Correct.
Gotcha. Okay, so let's say you sell property, you realize a large capital gain from the sale of real estate from your self-directed account. I'm assuming there's no tax consequence at the time of sale. Is that right?
Well, a retirement account is considered a tax-deferred vehicle. So, and the sale of the property will be treated, generally speaking, no different than if you purchased some stocks, right? And then a few years later, you sold with a large gain. Well, if you did that personally, obviously, that's going to be a taxable event. But if you did that inside of a retirement account, all of that gain will be sheltered from taxes. Because an IRA or 401k is tax sheltered vehicle. The same concept with the property. If it's done inside, no tax consequences.
So just like any other traditional tax deferred account, then you just get taxed at ordinary rates when you withdraw after 59.5. It's not, but any transactions before that are just tax deferred like any other retirement account. Sounds like.
Correct. Now, generally speaking, so you will pay the taxes on the amount that you take distribution. So you're not going to be taxed. I mean, if you sold a property worth $1 million and when you reach 60, you're not going to pay taxes on $1 million, you're only going to pay taxes on the amount that you take out. So if you only take out $50,000 when you're 60, and then, you know, the same amount every year, you're going to be paying taxes on the amount that you take out in the year that you're taking it out. But one other concept or important note is that there could be taxes that your IRA will own, and that's UBIT tax, and that stands for Unrelated Business Income Tax. And this tax is assessed when there is a income that is unrelated to the nature of the IRA. So for example, if you invested in an active business with your retirement account, one example will be flipping a property. Flipping is considered an active business. So if you actually buy a property, fix that up, and then sell it in a 3 months, that's considered a flip. And that may basically, that income may be subject to UBIT tax.
Even if it's purchased, even if it was done entirely in a self-directed retirement account?
Yes, because it wasn't a passive investment. All the investments inside the retirement account must be passive. If you engage in an active type of business, and as a result, the income from that type of business will be subject to UBIT tax. And that's tax, not you responsible, it's your IRA responsible to pay the taxes on. So you want to make sure that the investment that you make with your retirement account is passive.
Okay, gotcha. Good tip. And it sounds like the account administrator custodian would know how to, you know, process any tax liability if that happened. Is that right?
That will not be the administrator's responsibility or custodian's responsibility. That will be your responsibility. So you'll have to work with your CPA because the IRA will have to file a special form with the IRS. It's not a tax return, but reporting that income and paying those taxes. But that's outside of the custodian's responsibility.
I see. They just pay the amount, but you actually have to figure like calculate the amount.
Yeah, the tax amount is going to be, you know, whatever is involved in that calculating and filing and reporting, that's going to be your responsibility.
Got it. Okay, so has to be passive investment. What are other asset types that you can invest in with a self-directed account besides real estate? It sounds like, you know, you've invested in hard money loans, so private debt. Can I invest in like a closely held business, tax liens, physical assets like antiques or jewelry, intellectual property, maybe Bitcoin?
Well, the better question is, what can you not do? Or
sure.
Okay.
What am I not allowed to invest in?
Because with the self-directed IRA or 401k, like I said, you can invest in virtually anything. Now, there's a couple limitations. One of them I explained, which is a prohibited transaction that arise as a result of a disqualified person being involved in the transaction. So you cannot invest, you know, in a property that you're going to live in, or you cannot, if you're, for example, a real estate agent and you set up a solo 401k and you want to buy a rental, you as an agent cannot represent your 401k on that transaction. Whether you get paid or not, you cannot provide services to your 401k. Okay, but the IRS actually, they don't have a list of investments that are allowed. They don't have such list. What they do have is they have a list of transactions that are not allowed, prohibited transactions. And again, we talked about the transactions that may arise as a result of disqualified person being involved, but the assets that are specifically not allowed is collectibles. Okay, so anything that is considered collectible, you mentioned antiques. No, because that most likely will be considered collectible, so you won't be able to invest in that. And the other problem is that antique, I mean, if you buy an antique vase, okay, where are you going to store that, even if it was allowed? Because you cannot have it in your possession as a disqualified person. Now, if you buy in some golds, bullion golds, for example, again, you won't be able to keep them in your possession, but there are third-party depositories that specialize in this, and they can hold the precious metals for you. But yeah, so you cannot invest in collectibles and life insurance contracts. So other than that, and disqualified person, you can invest in virtually anything. So yeah, tax liens, tax deeds, physical real estate. You can invest in syndications. You can invest in real estate outside of the US. You can invest in Bitcoins or other cryptocurrency. Although you need a checkbook, you can do that with the custodial account. But you can invest in virtually anything other than these prohibited transactions.
Why can't you invest in Bitcoin with a custodian? You require checkbook control. Why is that?
Well, because you cannot have the custodian cannot open an account to invest in a Bitcoin. You need an exchange account. So, and custodian will not be able to set up an exchange account. So, or transfer funds to the exchange accounts, and they're not going to do that. So you do need a checkbook control for that.
Okay, got it. Hey, one thing I'm actually curious, based on this discussion, is really interesting. You know, like Mitt Romney, he was a former presidential candidate, and he used to work at a private equity firm called Bain Capital. And you know, legend has it that his Roth IRA is like $100 million, which is obviously mathematically impossible to achieve in a lifetime by simply doing contributions and investing in the stock market. And that's because he did it self-directed. He invested in companies that, you know, became very valuable. And then when they exited, you know, big distribution into his Roth IRA account. But he, I don't know all the details. I assume he did that through his firm Bain Capital, which he also worked at. I don't know if he was involved in those exact transactions, but even if he wasn't, I'm just curious, like the disqualified person rule. If I work like in, just like Mitt Romney's case, if I work at an investment company, like a private equity firm whose job is to go buy companies, turn them around, sell them for a profit, can I use my self-directed account, retirement account, to co-invest if I work at that company? Let's say I don't work on that particular transaction.
I'm not sure I can talk this in general terms, or I'm sorry, comment on Mitt Romney's, because I don't know exactly how he done it. I've heard about this, but you're exactly right. It's mathematically impossible to accumulate that much wealth just from the contribution. So you have to make these alternative investments. But yeah, it has to be arm's length. You personally cannot be involved in the transaction. So you can make the investment, but you personally cannot be involved in the transaction. So, you know, we will have to look at each particular scenario and see if if that transaction is prohibited or not. So I'm assuming he did it correctly. I'm sure he knew what he was doing and was following the rules. But if you're personally involved, if you working in a firm that may or may not be allowable, you have to look at the circumstances.
Got it. Okay, cool. Any other important rules or considerations that folks should be aware of when it comes to self-directed retirement accounts?
Well, I think it's a great tool, very powerful to help you build wealth for the future. And you can do that in a tax-deferred environment or even tax-free if you use Roth, whether it's a Roth IRA or a solo 401k, which has a Roth component. So you can actually invest tax-free with your solo 401k as well. But you know, you obviously need to understand the prohibited transaction rules. And one thing that or one piece of advice I always tell my clients is that if you're not sure about something, ask. But ask before doing this, not after. Okay, and I had that happen. I had people come to me and ask me question after the fact, after they did the transaction, which in a couple of cases was prohibited transaction. But that's one way to avoid making a mistake, is to talk. You know, it takes just a minute to make a phone call or send an email. I always respond to my clients quickly. And it just takes a few moments to actually ask that question. If you're not sure about something, ask. And that's how you can avoid potential trouble, potential prohibited transaction.
Okay, great. This has been really helpful. I've really enjoyed our chat, Dmitry. Where can listeners find out more about you, your work, your services?
Probably our website, sensefinancial.com. You can see it actually just behind me. So sensefinancial.com. There they can go on our, they can also find me on Facebook, on LinkedIn, or I would like to extend an offer to all of your listeners to schedule a complimentary consultation. So I'd love to speak with you one-on-one, talk about your goals, and help you with your strategy, and share some of the experience and wisdom that I gained over the years.
All right, excellent. Send me if you have a link to the complimentary consultation, like is there a sign up page, then send me that link. I'll link to that in the show notes as well.
Sure.
Okay, perfect. Dmitry, again, I really enjoyed our chat, and you know, best of luck to you. Stay safe, obviously, during this crazy time, and you know, we'll see you soon.
Andrew, thanks for having me. Great questions. Enjoyed the chat as well.
Cool. Cheers. Take care. Bye-bye.